policeman. Now, we mentioned that bond yields have been on the move. That's why I find those rate cut odds a little surprising. The 10-year is now at 4.3. It was almost 4.35 a little while ago. And both of my next guests agree these levels are a problem for stocks. Piper Sandler's Michael Kantrowitz joins us here in a moment. But let's start with Jim Bianco. He's president of Bianco Research. Jim, you've got kind of a similar take on this. Rising bond yields, especially in the wake of the jobs report today, tell you what?
I think what they tell us is the Fed's making a mistake. I think that the market is worried in the face of what has been a very strong economy and what is the potential of big fiscal stimulus if Donald Trump wins the election. We don't need rate cuts, and we're going to get lots of them. And Chicago Fed President Austin Goolsbee said we could get hundreds of basis points of rate cuts between now and the beginning of 2026, 14 months. And that's too much. And the bond market, I think, is starting to sniff out that there's an inflation problem. TIPS break-evens, which is a market-based measure of inflation expectations, have been rising, and that we're going to see another rate cut next week. And the market, I think, is worried that this is not necessary, and that's why you're seeing this adverse reaction of rising yields
just
in the face
on this
of
for
the
a
Fed
second.
cutting rates.
Stocks, let's just call, are more or less at all-time highs. So what does that tell you in
Right.
conjunction with what we're describing?
We don't need rate cuts. The stock market went up 17% between July 23 and September 24 when the funds rate was over 5%. It was fine with it. And now that the funds rate has been cut in September, it's gone up even faster. The stock market's telling us these rates are fine and we don't need rate cuts. But if you're going to give them to me and you're going to give me extra stimulus, we're going to shove stocks even higher. That sounds good. I'm not against that. But the consequence of all of that could be more inflation. All
right, let's bring in Michael Kantrowitz. He's here on set with me as well. He's chief investment strategist at Piper Sandler. Also, am I correct about this? Now you're the #1 portfolio strategist according to II.
Thank you.
Is that a new thing?
Yes.
But wow. All right. Nice job. All right. So, Mr. Numero Uno, what do you share Jim's kind of concern? This discussion reminds me a little bit of the Jamie Dimon sugar high comments he's made sometimes about the economy and the markets.
Yeah.
I'm just curious what you make of the landscape.
Well, I think, I agree with what Jim said, but to argue the market doesn't need more cuts, we don't know that yet because we're still pricing in cuts. So as long as that's the case, even with rates backing up, that's still a helpful backdrop. I think rates have gone up really since the data started getting better around when the Fed actually did their 50 basis point rate cut. You see it in the U.S. eco data, particularly employment data, besides today's report, has been significantly better, and the global economic surprise index has gone straight up in the last month or so. So those data explain bond yields really well, and the short end of the curve has gone up as well, kind of suggesting that it's not really so much about Trump and his odds of winnings, because if short-term rates, 6-month yields, 1-year yields are going up, the election doesn't really have an impact on that. The deficit issues aren't immediate, and what the Fed's going to do in the next 2 meetings is not really a function of who's going to be in office.
I think that's a great point, but do you then join the chorus of those saying that I know this isn't really, you just say, here's what they're going to do, not what they should do, but is it a sure case then that they're going to keep cutting rates if all the economic data is strengthening so much?
Well, at the margin, we've seen better surprises. And remember, 2.5 months ago, the markets were starting to get worried about a recession when the unemployment rate hit 4.3. So from the bottom of the 10-year bond yield at 3.6, the market's gone straight up, even though yields have moved higher because that narrative of recession risk went away.
Yeah, it's like the good kind of rise in bond
Exactly.
yields.
Now, though, I think it's starting to create a little more angst, and we're seeing that really in leadership. Commercial real estate was the best sector in Q3 as rates fell. It's one of the worst sectors since bond yields bottomed in the last month and a half. So you're seeing at the margin, it's not clearly high enough yet to become a broad issue for equities.
Does it tell you anything about small caps? Because usually a better growth trade is one that favors small caps. But then you get the high rates piece of it, which is supposed to disfavor small caps. And I'm just curious what investors should do.
Yeah, well, our view on small caps, and we've been relatively bearish on small caps for almost 3 years.
Wow.
And the simple reason is that their earnings have gone lower for 3 years straight. And estimates for 2024 and 2025 also are continuing to decline as recent as this earnings season.
Wow, okay.
So until that picks up, we want to continue to embrace companies with better earnings revisions, better balance sheets, and that is going to push you up in market cap.
And I know you guys always do kind of the quality bias here, but this has to make me think that, I mean, here's what's weird. This time, the rise in rates, we're not quite to the all-time highs, but you start thinking about the banking crisis, and you start thinking, you mentioned real estate. I mean, do we go back to that old playbook, or do you think this will be more transitory?
I think rates have to move a good deal higher, because the difference today from even in middle April when rates were rising, or certainly last year, is the Fed is cutting. And they've already started that, and they've made that clear. So that's certainly a support where yields could potentially move higher and not panic the market. And of course, everything the Fed has done in the last year or two, and the fiscal government, to make sure that problems don't arise, somewhat hacking the economy, if you will, I think gives us a lot more confidence that that's unlikely. I
appreciate that. Hacking the economy is a good phrase. Jim, how does it end?
I think it ends with interest rates eventually going too high. Now, I agree with Michael. They're not there now, and they'd have to go substantially higher from here. And I also agree that we are at about the level now where if rates continue to move higher, it's going to be a problem for the stock market. And the reason it's going to be a problem for the stock market is the era of Tina. There is no alternative. That era is gone. There is an alternative. The alternative now is high interest rates. For a lot of people, they're looking at the bond market, they're looking at bond investments, and they're saying, you know, I can get most of the stock market's gains or expected gains with a lot less risk, because in a bad year, bonds go down maybe 1%, where stocks could go down 20, as we saw in 2022. And they'll take that. And if rates go higher, you'll continue to see money move towards the bond market. Bond ETFs have already had a record yearly inflow, and we still have 2 months left in the year. And that would only increase, I think, if yields continue to move higher. So as they do, it becomes competition for the stock market, and it just becomes more of a drag. And eventually, if they go high enough, it becomes problematic, but that's a ways off.
Michael, quickly, do you agree with that? And what do you think is kind of an area where there's a lot of opportunity for alpha, for lack of a better word? I mean, maybe undeservedly low valuation, or a rotation that you foresee happening?
For the first question, yeah, I agree that rates are going to continue moving higher. We think global economic surprises will continue to improve into the end of this year. And the second point, where do you want to be positioned? Given that credit spreads are so darn tight and the market's really not worried about a whole lot, a lot of the lower quality and even small cap stocks that are up this year, it's all been PE expansion. So if there's not more worry to be priced out of the market, i.e. not much more PE expansion, you'll want to focus on earnings, and that's going to push you into mid and larger caps.
All right. Interesting. Gentlemen, thanks. Really appreciate it today. Michael Kantrowitz, Jim Bianco, thank you so much. Coming up, Berkshire Hathaway will